Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, April 23rd, just after the close. I'm going to keep it fairly brief this week. Bit of a churn in the markets. Remember, if we go back to last Friday's video, we did get a touch defensive last week. Raised a little bit of cash in our U.S. portfolios. We sit about 10% cash. Tactical, pared back on a very successful NASDAQ 100 trade that's been in the portfolio for 5 years. Brought it from 22% of the portfolio back down to 13% of the portfolio. That raised some cash in tactical trend to about 15%. That position's fine. We saw a little bit of volatility this week. In terms of headlines this week, the main one, higher taxes on the way, higher capital gains taxes. Administration's been very transparent about that, but the level of taxation is still up in the air. On the top end side, that could be restrictive. We'll let the markets tell us how restrictive. What our opinion is doesn't matter to the markets. But in terms of where we saw money flow, both Thursday during the headlines and even Friday, it tended to be to companies with very strong balance sheets. Tended to see a nice move even yesterday, post-headlines, into the drug companies, into the Bristol Myers, the J&Js, the companies that will continue to crank out growth regardless of needing the equity markets to help them out. Remember, if we're talking about higher taxes, somewhere along the line, you get an effective supply and demand. If money in the form of a tax or a penalty is being taken away from the markets or the risk takers, you tend to have less risk put on. Capital markets thrive on risk takers. If growth companies that are not profitable today, but are supposed to become profitable with a great growth plan 1, 3, 5 years from now, but are dependent on the markets to get there, if they can't get there, if that market starts to close down on them, are they worth the same as they were 3 months ago? Market will decide that. We'll react to that. Remember, trying to jump to conclusions on headlines ends up being a fool's game. Markets will give us plenty of time to digest and react and remain flexible. Interestingly, the international markets, both emerging and developed, while just up a tick during the week, didn't have that volatility off of the tax headlines here domestically. So perhaps we see some money rotate to international like we did for a brief period in 2020. Remember, international had a nice run, kind of petered out, and the S&P and U.S. small caps took back over from a relative strength standpoint. Going back to 2005 and 6, we're only at those levels today, 15 years later internationally. Can they get some consistent growth going? Be very interesting. We're very open, especially within our global equity and our tactical portfolios, to increasing our weighting there. We'll let the market dictate that. We have different levels and different entry points that are attractive to us. So everyone have a nice weekend. No reason to overreact to headlines. As we say, the enemy of a trader and investor is looking themselves in the mirror. Don't overreact. Know where your risk and reward levels are. See you next week.
Good afternoon. I'm John Mousseau. I'm the CEO and Director of Fixed Income here at Cumberland Advisors. It was a very quiet week in bonds. Think about the 10-year Treasury and the 30-year Treasury, down a couple of ticks for the week, 158 to 156 on the 10-year Treasury, 227 to 224, down 3 ticks on the 30-year Treasury. Munis unchanged both in 10 years and 30 years at 93 and 155 basis points. So those ratios really are maybe ticked up a little bit, but essentially they're at 60 and 70% of treasuries. They did this in the spite of some, what you would think is very, anti-bond news. What did we have this week? We had initial jobless claims lower than expected, down 547 when they were expecting somewhere north of 600. Very good news for the economy. New home sales off the charts, over 1 million versus expectation of 825. So those numbers you would expect would have produced higher yields. They didn't. What's going on? We think it's really the tax talk that's in the air. And that's in general because you're not only talking about higher income taxes probably coming. We've talked a lot of times that the muni market is very rich, and we think it smells a tax increase coming there. But in addition, now there's talk about increasing the capital gains tax, doubling it for high income taxpayers, which would take it from around 20 to north of 40. What does that do? Now, we don't know whether that's going to be etched in cement by any trip, and it might be a long time till you actually get to an agreement on something like that. But that has the real thrust of people wanting to own more munis. Let's take California as an example. Thank you to my colleague Sean Burgess for putting this together. If you looked just at a 5-year California muni, and we put some other maturities up on the chart, a 5-year California muni has gone from yielding about 85% of treasuries back at the end of the year, when munis were somewhat cheap, to basically 55% of treasuries now. That's an enormous, enormous downdraft in relative yield versus treasuries in less than 4 months. What is that saying? Well, it's saying A, we expect a higher tax increase coming. B, capital gains will drive someone at the margin from maybe trading stocks into just holding bonds, even if it looks so uneconomic at those numbers. And the third part is, hey, if I stay in California, I really don't have any other choice here. Now, there's also talk about relaxing the SALT provisions of the tax bill, which allow deductibility of state income taxes and, of course, local property taxes. That doesn't do a thing regarding capital gains, of course, but you wonder whether they will have to trade that off to try to get higher capital gains and a higher marginal tax increase. In addition, for munis, supply has been down this year. Common sense tells you that isn't that surprising with all the federal money that's out there. And we know with the last stimulus bill, $350 billion going to state and local governments. There is not the need to issue bonds as much as there might have been last year. The need is not as dire because there's federal money there. That's another driver. So, very quiet week. We're going to look next week. We'll get initial jobless claims. Take a look. We're going to get first quarter GDP, final numbers. We'll look at that. We do think the anecdotal evidence still points to some higher yields down the road. So the fact is that we have backed down a little bit from the 174 on the 10-year and the 239 on the 30-year Treasury that we hit back in March. We're down somewhat from there. We think this is basically the pause that refreshes, and that as you get to later in the year and you start to see not the year-over-year comparisons of inflation, because we know those are already baked into the cake. We know last year's were low in March and April. We know they're going to be a little bit higher this year. No, it's really the month-to-month-to-month comparison that we want to look at. March to April, April to May, May to June, etc. And that will tell us a bigger story about the demand factor that's out there and whether it's translating into not only some higher inflation, but more importantly, into the fear of higher inflation, which can carry bond yields higher in the market. With that, have a good week. We'll see you next week.